Welcome to the Home Building Hub, your essential podcast guide to building your new home. Hosted by industry experts Colin Bischoff and Darren Brennan, this conversational podcast will help better educate you about all things new home building so you can avoid costly mistakes and enjoy your building experience to the fullest, no matter which home builder you choose.
Hey there, folks. Welcome to the Home Building Hub. You're with Colin and co-host Darren Brennan as always. Today, Dazza, we've received a bit of feedback from people. They want more episodes about finance, how to purchase a house, how to manage the finance in terms of your loan, best way to get repayments sorted, and all those sorts of things. So what we thought we'd do, mate, is we'll jump on and get a really special guest who I know personally. This is a guy by the name of Scott the Broker Baker. He's the founder of a company and the CEO of the company called Toast Finance. Now, Scott is my personal broker, so he's a bit of a wizard when it comes to getting people approvals when most brokers, you know the ones I'm talking about, Dazza, the ones just want to tick the boxes.
Absolutely.
So that is literally how I met Scott. I was with a broker who ticked a few basic boxes and said, no, sir, sorry. And my accountant put me on to Scott and he went, yeah, no worries, here's a solution 3 days later. So this, as we say quite often, that's why you need an expert in the field to represent you and get you that finance for your circumstance. So Scott's going to join us for 2 episodes. This is the first one. We're going to cover the 5 things you need to know if you're self-employed and you need a loan. So Scott, welcome aboard.
Thanks very much, Colin, Darren. Great to be here, and thanks for the intro. Very, very kind words, Colin.
Mate, I spent hours preparing that.
I can see it was said from the heart. I love it.
Yeah, it's true. Well, in fairness, I did take a few notes, but because we've known each other for such a long time, I guess it could have rolled off the tongue a little bit. Yeah.
Love it. No, it's good. Great to be here.
Thanks,
mate. Scott, before we kick into the first questions, mate, tell us a bit about Toast Finance and how long you've been in operation, mate.
Yeah, so Toast Finance, is relatively new. I had my previous business under a bit like a franchise arrangement for 4.5 years. But yeah, last year wanted to create my own brand. It's just things I wanted to do with my business in the future, which, under a franchise just had some limitations and things. So yeah, worked with a branding agency for most of last year to create a brand, and that's where Toast came about. And we relaunched to the market in February early this year. And we've got an office down in Geelong, but service customers all around the country, and got a few brokers in the team, couple of client service managers as well.
Yeah, great, mate. Awesome. Obviously, this episode's about self-employed, and that obviously creates a number of challenges. Is that, I guess, and I'm suggesting that, but is that a true statement that it's challenging to find a solution for those that are self-employed? And how is it different to a traditional type employee type loan?
Yeah, it's a great question. And I feel it's one of the biggest misconceptions about running your own business and being self-employed, that you need bigger deposits. It's harder to get a loan. The banks don't like you. It's actually the opposite, I find. At the end of the day, if you've got income and borrowing capacity to service the loan, we're on. And I think with self-employed, a lot of the time we actually get more flexibility with how we can even, show income. And there's so many lenders these days that give you more options on how to verify income. And income's the big one. And this is where it's very much a broker, accountant, client relationship when you are self-employed, because accounting objectives and lending objectives are quite different. Now, your accountant, traditionally, they're there to obviously minimize tax. We all don't want to pay $1 more of tax than we need to. So
given
the accountant's there to be...
we probably should.
Yeah, I know. Right? So the accountant's there obviously trying to minimise your taxable income, which obviously minimises the tax you pay. However, when it comes to lending, if we're trying to get a loan approved to go and build something, it's important that we're showing enough income to, show the banks that you've got the income there to service the loan. So that's a really important structure that working with, accountant, client, broker on how we're going to structure your income, how it's all going to look, to ensure that the loan gets approved and you can obviously go and deliver your goals.
And just with respect to that, then, do you find, you're working with your client's accountant, or do you recommend them to move to a particular accountant, or, how does that sort of work?
It really depends on the accountant and the level of relationship they've had. I mean, there are accountants that will just do your tax returns. But for me, I feel like that's 10% of it. The other 90% is, structure. Like, they should be a small business partner, understanding where's your business going? What do you want to achieve? It's always a bit like a broker. I look at us and we're like 10% of it's the home loan. Like, we'll get the loan done. Don't worry about that. But the other 90%, that's the more meaty conversation about understanding your business. What are your goals in the next few years? Because all of that conversation helps determine how we structure the loan, how do we need to make it look, what product are we going to recommend to deliver the goal number 1, which might help you onto goal 2 and 3 and all of that type of thing. So, yeah, it's just really understanding the relationship they've had with their accountants. Sometimes their accountants are pretty simple, and that's fine. But sometimes they actually need to move on to another accountant who's a bit more strategic and a bit more of a small business partner.
Yeah, cool. So I guess if you're wandering up to the is it HR block, desk at the supermarket to get your tax done, that's probably not the accountant you're referring to. You're
Probably
referring to
not.
the more partnership style, which I think is really clear. So no, it's great, fantastic.
Definitely. I think if you just work for someone, you PAYG and get pay slips, and that's about it in your entire life, I think a HR block or similar would probably do the job. But if you've got bigger goals and you're a bit more complicated, or you've got a side hustle, or you've got other things going on, I think you definitely need more of an accountant who's more strategic and a bit more of a small business partner.
Or if you're a little bit like me, and when brokers start talking their language, and particularly accountants start talking their language, in my mind is a monkey with the crash symbols that just start crashing, just like, you lost me. Yep, that's what I literally have. And I just, when my accountant starts talking to me, I just say, I just stop him and say, I don't understand that. I don't want to understand it.
Yeah.
Just sort it out, please. And
I pay your money for a reason.
I think there's a lot of people in that boat too. And that's what you refer to, Scott, when you're talking about having a team. So accountant, broker working together to make it happen for your circumstance, your situation. So I guess in line with the topic, what are the different ways, so people who are self-employed, what are the different ways they can actually get finance for construction, just as a bit of a heads up for them?
Yeah, definitely. So lots of different ways. Also with construction as well, there was probably an old misconception as well. You need much bigger deposits and things. I mean, there are lenders right now you can do construction with just 5% deposit, which is great. Lenders over the last few years have been loosening policies, and where if you're going to build for investment purposes, you did need at least a 10 or even 20% deposit. But that's all coming to 5% now. So there's plenty of lending options that 5% for whether you're building a home to live in or as an investment property, minimum contribution down. From an income perspective, this is probably the big one for people who are self-employed. The one of the most common ways is to use your tax returns and financials to verify your income. But we're finding more and more people who are self-employed are using what are called low doc or low documentation loans to verify their income. And this is where we use either their BAS or an accountant's letter or their business bank statements to verify their income. And we're finding this is really popular because some people who are self-employed maybe haven't done their tax last year. Because preparing tax when you're self-employed, there's a bit to it. It's not something you do in half a day. So if someone's got a goal to deliver now and there's a property they need to commit to, want to get the build going, these low doc loans are very, very popular to get us a solution and kind of get it done and get the thing moving. And what we find with these low doc solutions as well, yes, they're more expensive. Yes, the rate's a little bit higher, but they're never long-term solutions. They're very much about they're solution-driven, and it's for someone who's like, I found the block, I've got the bill, I want to get things going. It's like, we can get it going. Let's get the thing built, get it done, and then by that time, maybe they've had their tax returns done, and we might refinance them then to a cheaper, longer-term solution.
Yeah, good. Um, Again, if you've just started your business, what's the game plan there? Like, you might only be 3 or 6 months in. Is there a minimum time you generally look at that someone has to be in their own business before they can, get a loan? And does that make it harder, that sort of shorter time frames?
Yeah, great question. It all comes down to risk for the banks. The banks are in the risk game. Now, traditionally, the least risk to a bank is you having your ABN for 24 months. Now, if you've had your ABN 24 months, every lender in the country pretty much will look at you for self-employed. Now, as we come more forward, 18 months, 12 months, 6 months, there are lenders that will do a deal. And 6 months is really the minimum. There's a couple of lenders that'll do 6 months, a few more at 12 months, a few more again at 18 months. But it just comes to how much you're going to pay to get the money. So, if you've only had your ABN 6 months, that's more risk to the lender. So your interest rate's going to be a little bit higher. But again, I talk to with this type of thing, it's almost not that rates are relevant, but rate becomes a lower priority in getting the thing done. Because it's very much like, well, what are you trying to achieve? You're going to buy this land, build this house. We want to get the project completed. Like, that is the goal. And if there's a premium they need to pay on rate for 12 months, well, generally when you look at the sums, it's really worth it versus waiting 12 months.
Yeah.
Maybe that block of land's gone up in value. They've got to pay more. Like, they would have been better just paying a higher rate, get the thing done a year ago, and, moving on to their next project or whatever's next for them.
How much can that rate be different? Like, what sort of percentage are you talking?
Lots of variables. Yeah, I'm going to say loosely about 1%. Again, many variables go into that with lenders and things. But when you work out the sums on what's the actual repayment difference, in per month, once you annualize that, it's really not a lot. And that's what we find with people. They hear rate. Everyone gets obsessed with rate. Like, oh, the rate's, 6.5, not 5.5 or whatever it might be. But it's like, don't worry about the rate. Like, just look at the repayment. Oh, it's X hundred a month. Are you happy to pay X hundred a month more, over 9 months to get the bill done? Then we can it's like, it almost becomes a no-brainer.
Well, the sums in my head then, like you got a $500,000 loan. It's costing you $100 a week, but you end up with a house that you really want, right? So, usually a happier family because it's your own, a greater level of pride to live there, et cetera, et cetera. You might have, your tradie, you might have vehicles you got to park in the driveway, and that's, the landlord doesn't like it because you got to park, your trailer on the grass or whatever. All those headaches disappear, right? So for $100 a week, it's not much really.
And this is the way up. This is so much what we do with our clients is it's focusing on the solution. Like rate's the last thing we look at. At the end of the day, we want to deliver the goal. And if the goal is to build their first home or build their first investment property, whatever they're doing, how do we achieve that? Right. Then we start to work backwards. Right. What lenders are going to do it? Pros and cons. What features do you need? Okay, cool. Then we have a little bucket of solutions. Cool. Then we go and find the cheapest option. But, the cheapest option doesn't mean anything if the loan's not going to get approved.
Yeah.
So it's like, who's going to get the deal done? How can we deliver the goal? Sure, these are our options. Then we go and find the cheapest solution.
Yeah. It's funny because we've talked about that. I remember we staked an episode late last year, October, November, around there. We put a stake in the ground and we said, guys, you need to buy now before interest rates are cut, before this, because like the difference between the money you would save by buying in October last year and buying now, we're talking in land, you were getting 40K rebates. And in build, 10, 20 grand, whatever it may be. And even earlier, if you bought pre the NCC changes and stuff. So this is funny because we kept saying it, but just when we say it, it sounds like a sales pitch. Like you should buy a house now because we're in the industry, but there's so many people still waiting because we've had another rate cut, which is great, but they're looking at the wrong thing. So goal number one, just get a house, like get in, and then you can refinance it later. And that's what people are missing. I think that's really important, whether you're self-employed or not. But I guess keeping on that topic, in terms of the time frame, it's obviously 6, 12, 18, 24 months, etc. What about those who, I guess, in terms of their income? So they're self-employed, but they've probably got a loss or minimal income in their case. What does it mean for them? Do they have to wait another full financial year, or what are the options for the people in that boat right now?
Yeah, and this is something we see a lot with people who run a business. They might be earning, generating 500 grand a year in revenue, but then you take out all their expenses and, might show a profit of 20 grand. And they're like, great, I pay virtually no tax. It's so fantastic. It's like, well, that's lovely. But then when we need to go and get a loan from a bank, you've declared to the government you only make in profit $20,000 a year. And this is where a lot of people get confused about sales and then profit. People think, I make 500 grand a year. So I wouldn't actually, no, you don't. That's your revenue. To make that revenue, you've got to spend all this money on expenses and you're left with 20 grand profit at the end. And 20 grand profit, it might be a couple with, one child or whatever it is. 20 grand's not going to go very far for 12 months to cover living expenses and all the other stuff. But what they do is a lot of self-employed people in that scenario, they take drawings out of their business. They kind of live off cash flow and things, but drawings are not things we can use as income to go and get you a loan. So those people in those scenarios, again, it's about solution. And if they want to get cracking and get moving, that is where we use the low documentation or low doc types of loans. And we get an accountant letter, as long as they've had their accountant more than 12 months, or we use their BAS. And lenders have calculations they use off your BAS, based on what industry you're in. They kind of shave the revenue down and work off a profit figure. And we find those accountant letter and BAS solutions also can give us a more accurate indication of where their business is today. Because if they haven't done their tax in 12 months, maybe their business is actually growing. Revenue's up, we're actually generating more money, but I just haven't got around to doing my tax yet. Or, last year was much lower because we had setup costs. Year one in a business, there could be all these expenses to set up their business, equipment, whatever they're doing. But now might, be looking to show a more rosy picture. But yeah, if their previous tax was lower income, it's low docs the way to go, which is, accountant letter, BAS, or business bank statements.
Yeah, cool. Great advice. Tell me, what's some of the benefits? And I hear about trusts and people buying in a trust. Maybe can you give our listeners a bit of a heads up on how all that works?
Definitely. There's a lot of talk going on, and anyone who's trawling Instagram and TikTok, there's a lot of people talking about trusts and all these things about how they can give you additional borrowing capacity. But there's a few things that people need to be aware of with buying in trusts. And number one is you need good advice, and your accountant needs to be the first port of call to understand whether buying in a trust is the right structure for you, because there's pros and cons. A few things why people buy in trusts. Number one is asset protection. So a lot of people who maybe own businesses and other things like that, they might buy in trusts for asset protection. Secondly is around distributing income. So you might have a trust and there might be a husband and wife who are, trustees and beneficiaries. And depending on whether the trust generates profits, they can push the profits to husband or wife, depending on what their taxable income is going to look. As for borrowing capacity, we generally find with trusts that if you're wanting to maximize borrowing capacity, you need to be putting in significant deposits into the purchase. And that's in the realm of probably 40 to 50%, because there are lenders that will take an accountant letter to confirm that that trust is self-sufficient and can meet its commitments. And that means that the rental income from the property in that trust covers, the interest on the loans, the running fees, rates, all the other costs associated. And right now, with where interest rates are in the market, we're finding, your loan to value ratio needs to be, somewhere around that 50 to 60% mark for that to work. And if you've got that scenario, this is where, yes, some lenders will take an accountant letter to confirm that trust is trading profitably and can meet its commitments, and we can just exclude that whole liability from someone's personal financial position. But something else with trust as well, and again, this is why I'm like getting advice from your accountant, and again, it's an accountant broker client conversation, because trusts are expensive. Your accountant's going to charge you a hell of a lot more to do your tax returns every year when you've got a trust versus if something's in your individual name. So there's lots of pros and cons to it. It's not a one size fits all strategy for everyone. And it's really understanding if you're your accountant, why would you bind a trust? What are the pros? What are the cons? What's the long-term plan as well? Because I've had clients that have bought properties in a trust and are trying to unwind and get out of it for personal reasons. So it's definitely one that advice is key before you go and jump into something with regards to buying in trusts.
Awesome. Yeah, really good feedback. And again, I guess if people have more questions on something like that, I'm sure they can have a chat to their accountant or give yourself a bit of a call on that as well.
It leads to, obviously, because my misconception from what I was told many years ago around being self-employed, which I have been a number of times, is that you pretty much just can't get finance until you hit that 2-year mark. And then even then you have to show that you're actually doing quite well. And that was definitely there. So that was my biggest misconception, I guess, historically. What do you think, with everything you've sort of given to those people listening now, what's the biggest misconception at the moment regarding obtaining finance? Is it still that, or is there something else at the moment?
With self-employed, if I look at the last 5 years, right now, it is easier than ever to get a loan if you're self-employed. Like, yes, years ago, you needed bigger deposits. Yes, there was more, you needed to even provide 2 years financials. There's so many lenders now that will just need your most recent year financials, and that's it. Because historically, lenders would want to see 2 years because they're trying to see trajectory. Over 2 years, right, is income the same? Or has it jumped up? Has it jumped down? Because, lenders have been forming a view of, I'm trying to give you a loan for 30 years. So we want to see 2 years to understand your business, and are we on an upwards trajectory or what's going on? But there are a lot of lenders now that just need 1 year. So your most recent year income. Your previous year could have been disastrous. Doesn't matter. They don't want to see it. 1 year financials. So it's actually easier to get a loan. You need less deposits. We can provide less documentation. And then it really comes down to your broker, who needs to sell the story to the lender, explain your business, what you do, why you're going to be good for the loan. But I think that's it. I think if you are self-employed, whether you're newly self-employed or whether you're planning to be self-employed, a lot of people, they could be a tradie. He's works for a plumbing company, wants to then go out on his own and do his own thing or start to subcontract. That doesn't just block you away from any lending for 2 years' time. And this is why I'm like, just keep talking to your broker. You need to be talking to your broker about what's the plan for next year, the year after. Because again, they can advise you and go, cool, you want to go and do this and start your own business. Love it. These are some things to think about. This is how long your ABN might need to be registered. This is how your income is going to need to look. Again, that just helps stimulate thought process for that person to go, cool, okay, I know if I go and do this, this is what I'm getting myself in for. These are potential obstacles I might find, or this is what I still can do. But it's keeping that dialogue open with your broker to understand what it means for you. But it's definitely, it's easier than ever to get a loan if you're self.
And on that, I suppose, is obviously people's circumstances do vary. But when you say it's easier to get a loan now, being self-employed, is that referring to an owner-occupier house they're going to go and live in? Or is that actually referring to an investment property? Is there a clean answer to that, or is it just strictly on their circumstances?
Yeah, it's even in both scenarios. Really in both scenarios, like the big difference for investors is you need less deposits, smaller deposits now than what you might have done a few years ago. But as for the income's getting verified the same way. So whether you're buying and building a house to live in or building an investment property, it's the same scenario. We're looking at your income from what your business, what you earn. Then we're factoring in projected rental income, any negative gearing if it's an investment property. For something for your own place to live in or investment, exactly the same conversation.
Very cool. I think the key also is to talk to a broker early, to really, in that journey. We often see people, we see it a lot in our industry where people will pay a deposit and they get all excited and then they're like, well, they wander down and have a chat to their broker and the broker's like, hey, handbrake, stop, mate. You're about 6 months ahead of yourself, or you might save some more money, or that sort of things happen. So aligning yourself with a great broker, particularly someone who's an expert in if you're looking to build a home in construction finance, because again we get varying different brokers, and often I think simply because of the time delay for the broker to get paid in a construction loan, often makes them not want to do the work, right? So they go, oh, bugger that, I'm not going to get paid for a year because the land doesn't title for a year. So not interested in talking to you. And the poor old customer's left there hanging. So, talking to obviously someone like yourself, Scott, who's an expert in construction finance and then can help them through that journey, whether you be self-employed or not, is really paramount to making sure that your dream of owning a home can come true. So, yeah.
That's it. And I think with house and land especially, a lot of the time, you might have to pay a deposit on land that doesn't title for 12 months. And that is critical to, before you go and, put a deposit on a block that you're committing to, that you understand you can afford what you're looking to build. You've had your credit file run, and then, your broker's understanding what's your plan in the next 12 months, and are you planning on having a child or changing jobs? Like all these variables can, hurt the application, because if you're buying a block of land that doesn't title for 12 months, we're not doing a loan application until about 2 months out from the land titling. And the reason for that is we can't actually get a valuation done on the property until it's actually been pegged out and a valuer can go and actually see the dirt, So this is the thing, we're advising people on, well, this is how things look now, assuming there's no changes to circumstances, we'll be good to go. But it's very much we got to keep talking, over the next 12 months, if circumstances are changing, you might change your job, like don't do anything until we talk and we can tell you the impact of what that's going to be.
Great advice.
It's good. So there you go. Self-employed people currently or planning on. It's good to know you've got options as long as you go to the right broker. And clearly, really, what we always say in the the content we provide is you do need a good team around you. So that is accountant, that is broker, and that's a really good sales consultant. From the builder too that you're choosing. Someone who's educating you and mapping it out for you, so you can then pass that information on to your team to give yourself the best shot at understanding what your options are. But so Scott, thanks for coming on for this episode. We're going to get on and do another episode for next week, so please make sure you listen to that one. But appreciate that. It's a topic of, mystery, the self-employment stuff, so it's really good to clarify a few of those things, and I'm sure some of the listeners will really appreciate it. So thanks for coming on. Appreciate that. And any feedback, any questions, guys, jump on the website, homebuildinghub.com.au, and we'll be sure to leave Scott's details at the bottom in the description as well for this one.
Thanks for listening to the podcast, guys. And just our disclaimer, whilst we're all about providing value to you, this podcast should not be considered as legal or financial advice. It contains general information only, and you should seek out independent professional advice on your personal situation before making any legal or financial decisions.
1, 2,